American households now owe almost $19 trillion. That sounds like the beginning of a crisis. Mortgages, car loans, credit cards, student loans. Layer after layer of debt sitting on the American household balance sheet. But this story does not look like the last one. There is no clear repeat of 2008, no nationwide wave of mortgage defaults, no sudden collapse in consumer spending. Millions of households are still making their payments. Many homeowners are still protected by low fixed-rate mortgages and years of accumulated home equity. So, why does record household debt not feel like a national emergency? Because the headline number is not the whole story. America can carry record debt and still avoid a broad financial crisis. But that does not mean American families feel secure. It means the pressure is uneven. It means the danger is concentrated. And it means the real question is not only how much Americans owe, but who owes it, what kind of debt they carry, and how much room they have left. According to the Federal Reserve Bank of New York, total U.S. household debt reached about $18.8 trillion in the first quarter of 2026. That is the big number. But most of it is not credit card debt, it is mortgage debt. The New York Fed reported mortgage balances of about $13.19 trillion. The largest piece of household debt is tied to homes. For many homeowners, that debt was taken on in a very different interest rate environment. Millions of Americans bought homes or refinanced when rates were much lower. A mortgage balance may look large on paper, but if the loan is fixed and the monthly payment is manageable, it does not create the same pressure as new borrowing at today's rates. That is one reason this moment does not resemble 2008. Before the financial crisis, the danger was tied to fragile mortgage lending, falling home prices, and borrowers who could not sustain their loans. Today's stress is different. The Federal Reserve's household debt service ratio, the share of disposable income going toward required debt payments, was about 11.32% in the fourth quarter of 2025. During the 2007 and 2008 period, that burden was closer to 15 or 16%. That gap explains a lot. Americans owe more dollars than ever, but required debt payments, compared with income, are still far below the levels seen before the Great Recession. That is why the country does not look like it is falling into a broad household debt collapse, but averages can be misleading. From a distance, the household balance sheet looks resilient. Up close, many families look stretched. One household has a low mortgage rate, steady income, home equity, and enough savings to absorb a bad month. Another household has rent, a car payment, student loans, a credit card balance, and no real cushion. They live in the same economy. They do not live with the same risk. That is the central tension behind America's household debt problem. The headline says debt is near record levels. The deeper story is about the type of debt, the cost of carrying it, and the households least able to absorb another shock. Credit cards show that pressure clearly. According to the New York Fed, credit card balances were about $1.25 trillion in the first quarter of 2026. That is much smaller than mortgage debt. But for many families, it can feel heavier. A mortgage can be fixed. It can be tied to an asset. It can stretch over decades. Credit card debt is different. Federal Reserve data showed the average commercial bank credit card rate on all accounts about 21% in February 2026. At that rate, a balance becomes expensive to carry. A family can make the minimum payment and still feel like the debt barely moves. That is why credit card debt can become so painful. It is not always one reckless purchase. It can be groceries, gas, a car repair, a medical bill, a utility payment, a week when income did not quite cover life. For some households, credit has become the bridge between what they earn and what life costs. That bridge has become expensive. Auto loans tell another part of the same story. The New York Fed reported auto loan balances of about $1.69 trillion. For many Americans, a car is not optional. It is how they get to work. It is how they take children to school. It is how they reach the grocery store, the doctor, or a second job. When vehicle prices rise and borrowing costs rise, the monthly payment becomes a fixed weight on the household budget. A family may not think of this as part of a national credit cycle, they just need transportation. But once the payment is locked in, it has to compete with rent, food, insurance, utilities, health care, and every other bill that comes due. That is where the squeeze begins. The Federal Reserve has warned that credit card and auto loan delinquencies are above historical medians, with stress concentrated among non-prime borrowers. That phrase matters, concentrated among non-prime borrowers. This is not a crisis hitting every household equally. It is showing up first among people with weaker credit, thinner savings, and less flexibility. That is often how financial stress builds, not all at once, not across the entire country in a single moment. At the edges, a missed payment, a balance carried one more month, a car loan that becomes harder after hours are cut, a credit card used to cover one emergency, then another. The economy can keep growing while that happens. The official data can still look stable while that happens. And for the households living it, the pressure is already real. The absence of a national crisis does not mean the absence of household pain. The Federal Reserve's report on the economic well-being of U.S. households found that in 2025, 63% of adults said they could cover a $400 emergency expense with cash or its equivalent. A majority could handle it, but a large share could not do so easily. For those households, debt is not an abstract financial category. It is the emergency plan. When savings are thin, credit fills the gap. When wages do not stretch far enough, credit fills the gap. When the car breaks, when rent rises, when insurance jumps, when a medical bill arrives, credit fills the gap. And once credit becomes the way a family maintains normal life, debt changes meaning. It is no longer just borrowing against the future. It becomes a way to survive the present. That is why the American debt story feels so different depending on where a household stands. A homeowner with a low mortgage rate may see the debt headlines and feel concerned, but not personally threatened. A renter trying to buy a home faces a different reality. Home prices are high. Mortgage rates are higher than they were a few years ago. Monthly payments are harder to afford. And without home equity, that renter does not benefit from the asset side of the household balance sheet. A retiree may have little debt, but still feel squeezed by higher living costs. A younger worker may be carrying student loans, rent, a car payment, and credit card debt before building meaningful savings. A middle-class family may be current on every bill and still feel like the margin has disappeared. That is the difference between making payments and feeling secure. A household can avoid default and still be under pressure. A household can pay the minimum and still fall behind financially. A household can look stable from the outside and still have no room for one bad month. That is why the phrase debt crisis can mislead. If the question is whether America is in another 2008-style collapse, the data does not show that. Debt service burdens are lower than they were before the financial crisis. Mortgage debt is not creating the same broad systemic pressure. Household debt relative to disposable income is not flashing the same warning signals seen in the years leading up to the crash. But if the question is whether millions of households are losing financial breathing room, the answer is more serious. The problem is not one giant cliff, it is a narrowing path. More income goes toward fixed obligations. More households depend on credit to absorb shocks. More borrowers are exposed to high interest rates on revolving balances. And the cost of a mistake keeps rising. That is what makes this difficult to fix. Lower interest rates could ease some pressure, but inflation concerns limit how quickly policy can move. Higher wages would help, but wage growth is uneven. Lower housing costs would change the picture for millions of families, but housing supply is slow to build, and local markets do not adjust quickly. Debt relief can help certain borrowers, but it brings trade-offs around cost, fairness, inflation, and lending standards. There is no single lever that makes household debt painless, and debt itself is not automatically bad. A mortgage can help a family buy a home. A student loan can finance education. An auto loan can help someone get to work. A credit card can cover a short-term emergency. The issue is not debt alone. The issue is when debt stops being a tool and becomes a trap. That shift usually happens quietly. At first, the balance is manageable. Then the interest cost rises. Then the minimum payment grows. Then savings disappear. Then another expense arrives. The household is still functioning, but the shock absorber is gone. That is why many Americans do not need a recession to feel financially stressed. They only need one bad month, a repair bill, a medical expense, a rent increase, a job cut, a higher insurance premium, a car problem. For a household with savings, those events are painful. For a household relying on credit, they can become the start of a spiral. This is also why official numbers can lag behind lived experience. The delinquency rate can remain moderate while families are already making painful choices. A debt service ratio can look manageable while households are cutting back on groceries, delaying savings, or working extra hours. A borrower can be counted as current while quietly running out of options. The data is still essential. It keeps the story honest. It shows that the United States is not simply reliving the last financial crisis. But the numbers do not capture every kind of stress. They do not show the anxiety of carrying a balance month after month. They do not show the family that pays every bill but cannot save. They do not show the household that looks middle class from the outside but is one emergency away from borrowing again. That is the story behind near-record household debt. Not collapse everywhere, not comfort everywhere. A divided balance sheet. Some households are protected by assets, fixed-rate mortgages, and stronger incomes. Others are exposed to high-rate credit, expensive auto loans, rent pressure, and thin savings. That divide explains why the headline sounds alarming while the economy keeps moving. It also explains why avoiding a crash does not feel like relief. What comes next depends on income, inflation, interest rates, and the job market. If incomes keep growing, inflation cools, and borrowing costs gradually ease, many households may continue managing their debt. Delinquencies could stay contained. The economy could avoid a broader consumer credit shock. But if unemployment rises, if borrowing costs stay high, or if essential expenses continue to pressure monthly budgets, the stress could spread, not necessarily as sudden collapse, more likely as more missed payments, more cutbacks, more defaults, and more families forced to choose between current bills and future stability. The most realistic risk is not a dramatic national debt explosion. It is a slow erosion of household resilience. That kind of pressure does not always announce itself as a crisis. It shows up in smaller decisions. A family stops saving for retirement. A worker delays medical care. A parent carries the balance another month. A tax refund goes to catching up instead of getting ahead. A car payment becomes harder to afford but impossible to escape. That is why household debt matters now. The real question is not only how much Americans owe. The real question is how much breathing room they still have. And for millions of households, that space is getting smaller. The crisis may not be everywhere. It may not look like 2008. It may not arrive all at once. But for families living close to the edge, the pressure is already part of daily life.